Hello and welcome back to MarketBeat's financial news and analysis. Today we are going to chat with MarketBeat contributor Thomas Hughes about something many investors are thinking are inevitable, the coming storm in the market, the significant downturn that may already be here. We're going to talk about what sectors are historically the best safe harbors during a stock market storm, the additional downturn we're going to be experiencing, and we'll even give you some names to consider adding to your watch list. Honestly, guys, you're going to be a little bit surprised when you hear the names of these companies. I know I was. Leave me a comment down below and let me know if you were as surprised as I was. All right, Thomas, it's so good to have you back. I've read enough of your articles and newsletters on MarketBeat to know you are not as bullish as many analysts out there, are you?
No, I'm not, Lacey. And I think to really illustrate this point, let's just go right to the chart.
Let's do it.
Yeah, so something interesting for our viewers to know is just in the couple of days since we started preparing this video, the market has not only peaked, but confirmed that peak and the downturn has begun. But starting back here, we talked about this a couple times, pandemic, market was trending nicely higher before the pandemic. Pandemic caused a correction. All that stimulus money caused this big bubble to form, and this bubble is popping. Within this bubble is the big story of inflation. Inflation's running out of control. The Fed is raising interest rates. That's having a negative impact on the forward outlook for S&P 500 earnings, and that's bringing the market down. So right here, we had a little bit of a bottoming and a rally because at this point, inflation appeared to be cooling, and then the Fed slowed down the pace of their interest rate hikes. And then guess what? This morning, the PCE price index came out and confirmed that not only is inflation still hot, it's reaccelerating in the near term and in the long term. This means that the Fed is not in control of inflation. It was a mistake to slow the pace of interest rate hikes. The next interest rate hike will probably be 50 basis points. Interest rates will rise to a higher level than the market has been expecting, and they will stay that way for longer. And that will all have a big impact on the forward outlook for earnings. So right now, the risk isn't so much that the market's going to correct back and retest this support. The risk is that the market's going to crash through this support level and come back to this trend line. Now, let me pull back to the big monthly chart to see how important this trend line is. I've got all these notes, but this trend line has been in place since 2009. It's been tested numerous times. It is highly likely the market is going to come back to this trend line before the bottom's in place. So that means we're either going to be moving sideways until 2029, or we're going to have a much deeper correction back down to the trend line, which is another 20 or 30% decline in the S&P 500.
All right, Thomas, so the downturn is here. We know that. What kind of stocks should we be looking at right now? Warren Buffett says the number one rule of investing is do not lose money. So where is it should I be investing? And actually, should I be investing at all right now? What should I be doing?
Well, that's a hard question, Lacey. It's hard to be an investor when the market's moving lower the way that it is. But when the market's moving lower, it's usually offering better prices. So long-term investors should try to take advantage of low prices and good stocks to dollar cost average and at the lowest possible average.
All right, let's go ahead and give our viewers something to consider. What are you thinking, Thomas?
Well, the furniture industry is an interesting story. It's one with history, and the story has legs. This story began way back in 2018 with the trade war. How many people remember the trade war? Right. So the trade war caused the furniture industry to rationalize its supply chains. They were deeply embedded in China and Asia. They were all overseas. Some of them have U.S. operations, but most of it's overseas and in China. So they've been working on their supply chains for quite a long time. So they were ahead of the game when the pandemic struck, and they've been ahead of the game throughout the whole story.
All right, you recently wrote about Ethan Allen, Haverty Furniture Companies, and Lazy Boy. As always, I'll put the link in the description below, anyone wanting to check out that article. But I'll be 100% honest with you, Thomas. Hope I'm not hurting your feelings here. It doesn't sound that very exciting to me, and I'm sure maybe not to others. What am I missing here?
Well, right now, Lacey, the exciting stocks are the ones that are having the biggest declines. And with the furniture companies, these are investments. They're not speculations on growth. These are blue chip companies. They're highly visible. Their businesses are established. And right now they've got positive cash flow. They're outperforming expectations. Business outlook is at least steady. I mean, it's not great because home building has a big impact on it, but it's at least steady. But most importantly, they have good cash balances. Cash is healthy, and there's no finance debt to be found in the industry. That means that their balance sheets and their cash flow is unencumbered by debt, and it's free for them to use for dividend payments or reinvestment in the business, or just to help them sustain themselves during these bad times.
All right, tell me more about the dividends on these. Are they what most would consider good, or?
Yeah, I would think so. The three that we mentioned, Ethan Allen, Haverty Furniture Company, and Lazy Boy, range from 2.65% yield to over 4%. They come with low payout ratios that are sustainable. They have a history of growth, and they've got a history of special dividends. So as I mentioned, they've got healthy cash balances, and they build up their cash during the year. So typically, like Haverty and Ethan Allen especially, will pay a special dividend at the end of the year, and the special dividend can increase the yield by double. So here we can see Haverty. Haverty got a nice boost from the pandemic, saw the pandemic bubble burst, and a nice rounding bottom right here with a reversal and some continuation signals. The post-release action's a little bit mixed, but it's broken out to a new high. So at the very least, I would expect Haverty to continue sideways in this range, if not trend higher to the top end of the range. But I think Lazy Boy might be the best opportunity in the market for furniture right now, because Lazy Boy has been lagging the market. Lazy Boy just confirmed its bottom and just confirmed its reversal with this week's earnings release, and it is on track to continue higher, up probably to this level, if not up into the $35, $40 range.
Are there any sectors we should be looking at, Thomas, other than what you had mentioned? Give us the names. I want to hear it.
Well, Lacey, you know I like the consumer staples sector. You know, yes. I like PepsiCo, and you know I like Kraft Heinz, but General Mills is another good one. It's packaged food. It's got brand strength. It's shown pricing power. It's got value, and it's got yield.
Right. The value is getting up there on General Foods, isn't it?
It is, but it's still a value at 19 times earnings. Others in the group are trading at 25 to 30 times earnings. Kraft Heinz is cheaper. Tyson is cheaper, but it's still a fair value for the yield.
Can you tell me a little bit more about the XLY, Thomas?
Yeah, the XLY is the consumer staples ETF. The yield's about 2.7% compared to the group. That's not as high as Kraft. It's not as low as some others. It's about the same as Pepsi. So as far as ETFs go, it could be a good solid addition to an income portfolio.
All right, Thomas, show us the charts. Tell us what you like about what's going on.
All right. Right. So you can see that General Mills has been in a nice uptrend. One thing that's noticeable about the consumer staples industry is that the pandemic is barely a blip on the radar. So you've got nice uptrend, you've got some pantry loading, you've got consumer trends just favoring consumer staples companies. The stock corrected because the market feared that margins might contract, but the earnings release belied that opinion. Stock has popped. We're back above the 150-day moving average, and I think the uptrend's intact. General Mills investors will probably see the stock reach the all-time high pretty soon, and it could set new all-time highs in 2023.
All right, guys, we're going to wrap things up here. But as you heard Thomas mention, he said we should be looking at PepsiCo and Kraft Heinz. And lucky for you, we did a video on those not too long ago. I'll link that above right here and also down below in the description. Thank you so much to everyone tuning in today. Don't forget that MarketBeat just released a brand new report titled The Best High Yield Dividend Stocks for 2023. Thomas here helped put that together. You're going to want to check it out. Right, Thomas?
Sure enough.
Yes. Well, before you exit, go ahead. Please leave us a comment letting us know if you'll be adding any of these stocks to your portfolio. Thanks again for watching. Thanks again for sharing your market analysis with us today, Thomas. I'll catch you in the next one.
Thanks, Lacey. See you next time.